Ever pause to ponder the importance of understanding insurance contracts? Well, the significance cannot be overstated. This is the agreement that binds you and your insurer, and it's crucial to comprehend its elements to ensure you're adequately covered and aware of your rights and obligations. Insurance contracts are not exactly light bedtime reading. They're complex documents filled with legal jargon. However, they have some key elements that can be broken down into simpler terms. Let's dive into these elements. Firstly, have you heard of indemnity and non-indemnity contracts? An indemnity contract aims to put the insured back into the same financial position they were in before a loss. So, if your car is stolen, your insurer will compensate you for the car's value at the time of the theft. On the other hand, non-indemnity contracts, common in life insurance policies, don't consider the financial position before the loss. The insurer simply pays a specified sum upon the occurrence of an insured event, like the death of the policyholder. Next, we have insurable interest. This concept means that you must stand to suffer a financial loss if the insured event occurs. For instance, you can't take out an insurance policy on a stranger's car because you wouldn't be financially affected if anything happened to it. Then there's the concept of subrogation. This is when an insurer, having paid out a claim to the insured, steps into their shoes to recover the money from a third party responsible for the loss. So if your insurer pays you for a car accident caused by another driver, they can sue that driver to recover the money. Now let's talk about the doctrine of utmost good faith. This doctrine dictates that both parties in an insurance contract must disclose all relevant information. If you, as the insured, fail to disclose pertinent information or misrepresent facts, your policy could be voided. There are also other doctrines at play in insurance contracts: adhesion, waiver, and estoppel. The doctrine of adhesion means that the insurer drafts the contract and you, as the insured, either accept it as is or reject it. You can't negotiate terms. The doctrine of waiver refers to the voluntary relinquishment of a known right, while estoppel prevents a party from contradicting its previous position or statements if they have been relied upon by another. Lastly, we have endorsements and coinsurance. An endorsement is a modification to the policy, while coinsurance is when the risk is shared between the insurer and the insured. In summary, an insurance contract is a legally binding agreement filled with key elements that dictate the rights and responsibilities of both the insurer and the insured. Understanding these elements, from indemnity and non-indemnity contracts to insurable interest, subrogation, the doctrine of utmost good faith, the doctrines of adhesion, waiver, and estoppel, and the concepts of endorsements and coinsurance, is crucial to making informed decisions about your insurance needs. So the next time you're handed an insurance contract, don't just skim through it. Take the time to understand these key elements and ensure you're getting the best possible coverage. After all, knowledge is power, and understanding your insurance contract is a step towards financial empowerment. If you need help with your commercial insurance, please reach out to Howard Insurance Brokerage at 888-702-4654.